1929. Because price was fluctuating. These financial statements are not informative because it's a fluctuating here. So 1989, 29, that happened, and on 1930, 34 SEC Act, new SEC set up, and 100% historical. From 100% market value to 100% figure. Now, here they look at relevance of financial reporting. It has to be relevant to make a decision. Now, doesn't matter what the relevant figures are. Here they go for 100% reliability because they were scared of market crash, and then they say, okay, whatever reliability we bring into financial reporting, we go for that 100% history. Now, 1970-72. This 100% history cost, it was good during that period. But then, U.S. corporations are becoming multinational corporations, and they are producing this inventory. Whenever new inventory comes out, old inventory becomes scrap value. And they still carry historical cost, which is a scrap value, and they are overstating financial statements. So they are making first exception to historical cost right here, which was what? Inventory cost. That was the first exception to historical cost accounting, 1972. Which was what? Lower of cost or market. It's not only historical cost. If market value is lower than historical cost, lower market value will be the new cost. That's the first exception. After that, exception. After exceptions. Now we are heading into relevant from 100% relevant reliability. We are heading into that. And here, the lobbying group is stopping adoption of 100% a fair value accounting, which was IFRS. So it's a decision, trying to make a fine balance between these two. How much relevant, how much reliability we are making, trying to make fine balance between these two. Crash by account, reverse order, we know that. We know the reverse order. From, liquidity, we say most liquid asset first, but then most liquid asset or not, or the IFRS. Income statement, I gave you income statement format. Even simpler than a balance sheet, revenue, expense, and income, but we don't have this type of income statement if you go somewhere else. Non-controlling interest. We'll go back to this non-controlling shares. What's the simple explanation for non-controlling interest? Somebody said minority interest. What would be a one plain English explanation for minority interest? Who are they?
Companies that you own that you do not have
okay.
shares to control.
Okay, the portion of subsidiary that you don't own to the parent company because they group of non-consenting shareholders who refuse to join merger and acquisition for many different reasons. For example, this investment is my investment for grandchildren's college education, so I'm not supposed to touch this one, or family blind trust. We decide not to touch this one, I'm not going to sell this. That will be only 5, 10, up to 20% range. So those are classified as non-controlling interest in consolidated financial statements. Here, corporate governance is important. Non-controlling interest is less than half. So if this is the 5% or 10%, you don't worry about governance issue. You are not going to lose control. But what if this is 46, 47% here? You might lose control over this company once they keep acquiring shares. So that is a percentage of non-controlling interest is important for corporate governance perspective. And accounting for that, we go to later module 2. Margin, net income as a percentage of the sales. Here, if this is the net income margin. If I draw turnover here, let's say this axis represent turnover. I will say turnover about this way, right? In order to maintain same margin, you have to increase. As your margin is getting lower and lower, you increase your turnover to maintain certain net income margin. Yeah. Southwest Airlines. Competition. If you see 100 passengers on any given flight, 100 passengers probably will have 100 different prices. Most likely. Depending upon what time you purchase ticket. Target. Caterpillar. Starbucks. As opposed to Apple, Google, Intel, and this is a little bit surprising, right? I'm sure this is a little bit lower now. We'll get the formula. Formula will be right there to here. Up to here, this was the 1997 and on. We are showing comprehensive income as well. Comprehensive income includes not only income but all income from other accumulated income such as foreign currency translation adjustment, pension adjustment, and all other adjustments that we'll talk about in this section. So we'll go there. Question. We all know accrual basis and how we recognize revenue recognition. As a cost allocation, this is nothing but matching principle. Revenue recognition principle, matching principle, we know that. Merchandise report cost as an expense. When the product is recorded, how much we measure the cost of product that is sold by merchandiser and by manufacturer. Well, manufacturer, we already know the cost of sending out this will be expense, but for buyer that will be part of transportation in. So that transportation in will be part of manufacturing cost. We all know the basic increase in value. We already talked about revaluation capital. We don't touch long-term asset and doesn't affect the balance sheet. But under a IFRS, at least you recognize the increasing value of the long-term asset. Wages, this is nothing but allocating your accruals. And the wage payable should be allocated between two pay periods, even if you pay cash in one period. Not all of people profit on translating their own stock because this is owner's transaction. Transaction involving own stock is not genuine transaction. It is owner, so we record in stockholders' equity section, not the income statement. Stockholders' equity section. Now, here. This is simply now this one. We have to spend a lot of time on this one. We already know this one. Non-controlling will be our main focus, and other comprehensive income. So we don't have standard format here. Contributed, retained earnings, other equity, and then a non-controlling, non-consenting shareholder, and total 191 million at the end of the year 2012. That is the total equity. Here, we spent a lot of time on this. I don't think we need a lot of discussion on here, other than implication for transaction type. Always something important happening toward the end of the fourth quarter. Why? Why most of the important transactions, financial transactions, happen toward the end of the fourth quarter?
Because they know what the numbers need to be.
Exactly. January, February, March, early in the year, they just don't know what EPS they report. By the end of the year, they know what numbers they need to beat the target EPS. Major financial transaction will influence the outcome for that year's EPS. So this one also, share transaction. If you can influence net income, you go to a denominator. In other words, here, net income such as preferred stock dividend, and that is your numerator. This is the weighted average common shares, weighted average numbers of common share outstanding. So if you look at here, we are watching this closely, but the manipulating stock outstanding, so you can do reverse stock split, stock retirement, and treasury stocks, and doing those transactions, you buy back your stock from the open market by paying open price, market price, that will reduce your denominator, and that will have a positive impact on your EPS. So they can do both, increase and decrease, to get double impact on their EPS computation. That's usually what they do. Cash flow, Berkshire Hathaway, cash flow. They don't give out any breakdown, just one number. Cash flow, investment financing, operating, and this is the world-leading financial thing. Net earnings, you start with net earnings, net income, and then adjust non-cash and current items to get CFO. This is a direct format or indirect format? Indirect. Why 99% of the time they use indirect format? Easier. Why easier? Easier or cheaper? Either way. Cheaper. Why? Good. You're on the right track. Because you already have income statement and balance sheet item, you don't need any more new accounting information to report your cash flow statement. For direct information, you need cash invoice, cash-based accounting record. In other words, if you want to report cash flow statement based upon direct method, you need to hire additional accountant, bookkeeper, based on cash basis. But that's more a theoretically consistent with the cash flow statement. That comes with what? That comes with what? Cash collection from customer, cash payment to supplier, tax item. That's a CFO. That's a very simple, which is very informative. Not here. Same CFO here, but then much more item because they already have income statement balance. Yes. Out of Fortune 500, one firm, the defense contract. What? Is it Lockheed Martin or not? The other one. No, not Boeing. Lockheed Martin. They use direct format because they have only one customer, U.S. government. And they don't default because what? They can print out cash. That's the only one reason why they can file bankruptcy. They can print out more money. Risk See, that's why. That's why. Well, this one, direct, indirect, same. This one. But for this one, well, this is what says at first, 1985, 86. Oh, I don't think I read some paper. Everyone has to use direct method. That was the best information. There's no exception. Then they lied. Look, you want to hire additional accountants, and that cost will be part of our product cost, and general public, you and I have to pay for this. Why don't you allow us to use indirect format so that we use information available so that we don't have to hire extra accountants. So that's when FASB says, okay, we still believe direct format is more informative and consistent with the idea concept of cash flow statement, but now you are allowed to use this format. Well, 99%. No additional cost. But it's confusing, you know. From net income to cash flow, you are adjusting from what? From accrual basis of income to cash basis of income. And can you imagine you explain why you add back the depreciation and amortization to your friend whose background is liberal arts? Never took finance, accounting, or economics. You explain this. Average Joe will never explain that. You understand this? You have to explain. That's the problem. And what information we are gathering this? Well, we will find out information. Financial cash flow statement, balance sheet, because we have sufficient cash flow. Well, I already explained why we need cash flow statement on top of income statement and balance sheet. One has to be cash basis. See, bottom line is this. Do they bring enough cash to maintain their quality of asset and pay committed fixed dividend? That's it. Once again, do they bring enough cash to maintain quality of their asset, which they need for keeping the production level, and then pay committed level of cash dividend? If they don't do these two, they are in trouble. If they have to borrow money for these two basic functions, they will be in trouble for years down the road. Because if you borrow money to pay dividend, borrowing from Paul to pay Peter, you are in trouble right away. You just don't pay dividend from loan. And that's why cash flow statement is too important. Look at CFO. Is this good enough to maintain quality of asset? How do I know the quality of asset? Balance sheet information has total life of the asset on the average, gross property, plant and equipment divided by annual depreciation is number of years they can use, and then accumulated depreciation divided by annual depreciation is number of years asset used. If you use 70-80% of the asset, cash flow is not stable to replace aging assets, you're in trouble. You have to either borrow money or print out stock. By that time, stock might not be doing very well if they know 80% of the asset has been used. So financial statement will provide all the information. And cash flow statement will reconcile all this accrual basis using cash. Financial cash flow information. Well, we already know the important. What kind of activity? Well, we all know operating activities coming from income statement, investing is from left hand side of balance sheet, right hand side of balance sheet. Here, is it important for a company to report net cash flow part relating to operating equity over the long term. Yeah, and if you keep reporting negative operating cash flow, that means you are reporting negative net losses from net income. So this model will not sustain for a long time. You better have positive cash flow for this extended period of time. Well, you have to either borrow money or print out stock. This happens again and again, which may not be sustainable over the extended period of time. Now, important to know the company's investment activities. Why is it important? Well, if you invest nothing but in treasury stock, that means you are pumping extra cash into treasury stock, which means from the stock market point of view, you don't know how to invest because you are temporarily parking your money with U.S. Treasury bills, which earns close to nothing these days. You're not even earning the interest, the inflation. You're not catching up with the even inflation by investing in U.S. Treasury. So that is really the important item. But we'll understand why people dump their cash into treasuries, the U.S. Treasury managers at the end of the period because that increases your return on the paper. We'll get to that. This is a popular gimmicks that they are using, and we'll get to the bottom of this using formulas. Company financing was very important, whether debt financing, equity financing, implication of their pecking order, the composition of a finance cash flow change over lifetime cycle. Well, cash cow operating CFO will be higher and CFI will be smaller because you might not feel that you need as much investment because cash is coming in at the peak from your product life cycle. Bottom line, including cash flow, the key numbers. Bottom line in cash flow. What is the bottom line? Cash is the first item in cash in income statement. Well, this is what may not be key numbers because this is how much cash you have at the end of the period. If you have a huge amount of dollar, that's good, but then might be more than what you need for the cash checking account. If you have a low number, you might be in trouble as well because you might have a liquidity problem. Well, retained earnings, I explained the connections among different statements using the graph. Well, the graph is here, but income statement, stockholders' equity, balance sheet, and cash flow statement that will display the interconnection among the three different financial statements. NDNA, CPA report, independent CPA report, audit report, financial statement footnote, regulatory filing like 8K, whenever you file your independent CPA here, they must file 8K. Tons of other filings will get paid, and each will affect the share price. Proxy statement, who owns what percentage of your stock, how much compensation each CEO or top 5 management people got for this fiscal year end. Now all this information is valuable information, especially for this one. This is just supposed to be independent. If they say, okay, everything else is okay, except for this one, you're in big trouble. Even if there is a minor problem here, except for qualified opinion, that will drive your stock down. Except for qualified. You must have clean bill of opinion, financial head from independent CPA, standard 3 paragraph without attaching anything. Standard. Otherwise, other than that, market will react negatively for the different formula, even if that is still unqualified opinion. Footnote, location of disclosure matters. They will never disclose contingency item at the front of the footnote. Commitment and contingency is always all the way at the end of the footnote. Why? The small fine print says we might be liable for $2 billion damage. $2 billion damage all the way at the end of the footnote with the fine print, but that will make a big difference in terms of impact. That's why you have to be in between the lines at the end, and they try to hide all this information. Yeah, well, now we are adding all these form infrastructure, internal control structure, financial management, human resources, all this, and we are adding all this. This will be part of your analysis. I don't hold you for responsible for incorporating all these implications, but at least you have to mention for obvious items, inbound operations, outbound marketing and sales, obviously, everything would be the one big operation, and internal control from a accounting point of view would be very important because strong internal control will add value to the on top of strong sales. And this is a portal 5, micro portal, has been going around the world, advising multinational corporations, almost all foreign countries, about 17, 18 years ago, he was charging $25,000 for 1 hour lecture. Right now, I don't know how much he charges. If he goes around the world, giving lectures to each head of the state and cabinet, I don't know how much he charges. And he's using this total size. Industry competition will determine your price, your strategy, bargaining power of buyer. If I buy like a Dell or the Worldly, I have power over marketing channel, suppliers, bargaining power over suppliers, the other way around. Substitution is high, substitution, they can go with either tea or coffee, you just can't increase the price. Threat of entry, anybody can come into this business, or threat of entry is really high, you don't have to worry about having another rival company, or affect your, this is a total file in graph. Competitors, buyers are here, entrants and suppliers, stakeholders, all stakeholders. They will influence your business and your financial reporting process. And we will get to each one of them as we move along. Well, I prefer Portal 5 because SWOT and Portal 5, it's either use one of them, but they say they add a C. SWOT plus C now, challenge. See, SWOT analysis plus C, which is strength and weakness and opportunities and threats, and plus challenge. We have SWOT, new model, add a C to the SWOT. Either SWOT or Portal 5. I prefer Portal 5 because it has more to do with financial reporting. I know this is very popular risk assessment model, but I prefer Portal 5. Well, we all know this. We all know this. So nothing fancy. Nothing fancy. So it's either net income or this, net income and asset, net income, the return on asset will be two components, profit and turnover. In other words, efficiency, productivity, and profitability will determine how well you did. Now, this is simple enough because if you look at the graph, that graph will tell you later on. Let me go to graph. line is about 12%. So whenever you are in this line, if your profit margin is thin, your turnover must be higher in order to be on the line, in this line. But if your profit margin is 25% and is strong, you don't need as much as turnover. You can't have as much as turnover because of industry. So you will be on around this level. So in here, or here, below, efficient from here, efficient from here. Below, less profitable, less efficient. More efficient, more profitable. If you are on this line, you are averaging total a industry, average industry. So, what that is, model as mathematical model. That was what? Yeah, at first grade I covered a few slides and look, first module, second module, broad overview. From module 3, we dive into models, mathematical formula. Not extensive, but we'll go into more a technical aspect. Analysis from model 3. So let's start getting textbook. Or you already have textbook. That will be most powerful. And let's try the homework. I grade homework by completeness. As long as you show me your answer, that's fine. If you don't try, you'll get half of the point. But if you try them all, you get the full point. You have to show me your answer. And this is a broad overview. I guess we were jumping around one topic to the other. Accounting can be it's much fun anymore. Module 3, we're going into those models which will produce return that everyone wants to have, and how financial statement will affect the total compensation mechanism and or financing loan on demand, and we have to know those detailed models. So that will be copied from the module 3. Any questions?
Could you talk a little bit about the 400 exams? Which questions?
Today,
Essays.
first day of class, and you're asking for that on the exam. Somebody's getting ready for the exam now. Exam 100%.
We learned our lesson in the previous class.
Okay, yeah, well, 100% problem solving. 100%. This is supposed to be master accountancy program. Soon as next May commencement is over, you will be master of accountancy. So supposed to be technical and challenging question, but based upon our discussion, I hate surprise. As much as market surprises me, I hate surprise. Just overall understanding of the course material. 100%.
For problem solving.
Problem solving. I mean, there will be no multiple choice.
U.S.
See, State Board of Accountancy never allow you to do anything to the CK exam. So that portion, we'll talk about it later. For that portion, what kind of exam I'm preparing, then I'll let you know. But either way, it will be test on the overall understanding of the course. How much we use financial statement to make informed decision about investment and credit. Okay? Did I answer your question?
He was not sure. He was not percentage before.
Any Any other questions? Otherwise, 11 weeks. Now, first we go 10 weeks we go like this. Let's not get behind, and as much as you have questions, you learn as much. Keep asking questions. Come to the class with a list of questions so that your classmates will get benefit as well. So I'm proud that I finished all the slides. We'll go on to tomorrow, next Saturday. Okay? It's a lunchtime.
Next Saturday.
Next Saturday we're not here.
Oh, you're not here?
We're not here next
We're
Saturday.
not here.
Labor Day.
It's Labor Day.
Oh,
Tom said.
2 weeks from today. Oh.
Why can't they just
Yes.
I'll be happy to serve jackets at lunch.
I've already printed that.
So we're laying over five.
There's a blanket.
Did you have to? Did Robin have to rent a room? She go to the hotel to rent a room to get the robe. Did you have to rent a room to get the robe, or?
The rope?
It's a wrap. Okay, I'm cold.
It's a beach town.
Lunch, guys. Discuss
Yeah,
lunch.
everybody else wishes they had one.
No, no.